Hello there, and welcome. This guide is brought to you by the folks at My Tax Accountant. Today, we're diving into a really important question for anyone with savings. When do you actually pay tax on your fixed-rate bonds? It sounds simple, right? But you'll soon see that the timing of it all can make a huge difference to what you end up paying.
You know that safe savings bond you've got your money in? Well, it's a great, straightforward investment for sure. But, and this is a big but, without the right know-how, it could be hiding a nasty surprise tax bill. And with interest rates where they are now, this is a bigger deal than ever. So in the next few minutes, we're going to make sure that doesn't happen to you.
So, here's what we've got on the agenda. We'll kick things off by looking at that potential hidden tax bill. Then, we'll pinpoint exactly when tax strikes before we cover your tax-free shields. After that, it's the practical stuff, reporting to HMRC, and we'll wrap up with some really smart ways to cut your tax bill and dodge those common traps. Sound good? Let's get into it. Okay, let's get right to the heart of the matter. The single most important thing to get your head around is the tax trigger point, that exact moment your interest becomes taxable. And trust me, it's not always when you think it is. Nailing this one idea is the key to everything else we're going to talk about today. So, HMRC, the UK tax office, uses this official-sounding phrase. They say interest is taxed when it arises. What does that actually mean? Well, in plain English, it's the moment the interest is either paid to you or simply made available to you. It doesn't matter if you take it out and spend it or just let it sit there. The second it's credited to an account you could access, the tax clock for that year has started ticking. Let's look at Jonathan's situation to see how this works in the real world. So, his 524 quid of interest was credited on New Year's Eve. He didn't touch a penny of it, but just because the money was available to him on that day, it became taxable in that tax year. It's a perfect real-world example of that arises rule. It's the ability to get the cash that triggers the tax, not actually taking it out.
And this is where things get really crucial. It all comes down to the terms of your specific bond. If you can get your interest each year, even if you have to pay a penalty to do it, then it's taxed each year. But if that cash is totally locked away until the bond matures, then all that interest that's been building up gets taxed in one go in one massive lump sum in the year it matures. And that can be a big deal because it could easily push you into a higher tax bracket.
So here is your first pro tip for today. You've got to read the fine print of your bond before you put your money in. Those terms and conditions are what decide your tax timeline. You're looking for phrases like interest paid annually versus interest compounded and paid at maturity. Understanding that simple difference can save you a very nasty surprise from the taxman later on.
Right, it's not all about paying tax. It's also about knowing how to protect your money. The good news is, the UK tax system gives you some brilliant shields for your savings. So now we know the rules of the game, let's look at how your allowances can legally protect that interest income.
So first up, everyone in the UK gets a personal allowance. Just think of this as your first line of defense. For the 2025-26 tax year, you can earn this much. That's £12,570 from all your income combined. So your job, your pension, your savings, everything, before you have to pay a single penny of income tax.
Now, on top of that, you get another allowance specifically for savings interest. It's called the Personal Savings Allowance, or PSA. As you can see here, if you're a basic rate taxpayer, so your total income is somewhere between about 12.5 grand and 50 grand, you can earn an extra £1,000 in savings interest completely tax-free. If you're a higher rate taxpayer, that drops to £500. And if you're an additional rate taxpayer, well, unfortunately, you don't get a PSA at all.
And here's a little did you know for you, and it's why this is so important right now. The government has frozen the income tax thresholds. What that means is, as salaries and savings rates go up, more and more people are being dragged into paying tax on their savings, often for the very first time. It's a thing called fiscal drag, and it makes understanding and using your allowances absolutely vital if you want to protect your returns.
Okay, so what if your interest income actually goes over these allowances? Well, that's when you have to officially let HMRC know about it. So, let's walk through the self-assessment process. It's the official system for declaring this type of income.
I know it might sound a bit scary, but it's totally manageable if you just break it down into these 4 steps. First, if you're not already registered for self-assessment, you need to get that done online by October 5th. Next, grab all your bank and bond statements. You're looking for the gross interest figure. Then, when you're filling out your tax return, find the box that says Untaxed UK Interest. And finally, make sure you file that return and pay anything you owe by the big deadline, January 31st, to avoid any penalties.
Let's make this a bit more real.
Meet Alex. He's a freelance graphic designer living in London. His income is £38,000, which puts him right in the basic rate tax band. He also earns £1,200 from a bond. Now, thanks to his personal savings allowance, that first grand of interest is completely tax-free, so he only has to pay tax on the leftover 200 quid. At his 20% tax rate, that works out to a simple $40 tax bill. See how that allowance did all the heavy lifting for him?
Okay, so we've covered the rules, we've covered the reporting, now for the really fun part. How you can legally and smartly reduce the amount of tax you actually pay. We're moving from just being compliant to being strategic, making sure your money is working as hard for you as it possibly can.
Your absolute number one weapon in the fight against tax is the ISA, the individual savings account. Think of it as a tax-free wrapper that you can put your savings into. For the 2025-26 tax year, you can put up to £20,000 in ISAs. And just look at this example. A higher rate taxpayer has a £20,000 bond that's earning 4.5% interest. That's £900. In a normal account, they'd pay 40% tax on that, a whopping £360 bill. But inside an ISA, they keep the entire £900. It's a massive, straightforward win.
But the smart moves don't stop with ISAs. You could think about staggering your bonds so they mature in different tax years. That spreads out the income and stops one big payment from pushing you up a tax bracket. You could also time a bond to mature in a year you know your income will be lower. Maybe you're taking a career break or just retiring. And don't forget, using your spouse or civil partner's allowances by holding assets in their name if they're in a lower tax bracket is a simple but incredibly effective strategy.
Now, while all these strategies are great, you've also got to play good defense. There are a few common pitfalls out there that can trip up even the most careful savers. Let's take a look at these hidden traps and, more importantly, how you can sidestep them completely.
First up, the emergency tax trap. This one catches so many people out. It often happens when you cash in a bond and get a big lump sum. HMRC's automated system can get confused, see this one-off payment, and think it's your new monthly salary. Then, bam, they put you on an emergency tax code and you get way overtaxed through your job's payroll. The solution? You've got to be proactive. Check your tax code on the gov.uk website after you get a big interest payment. If it looks wrong, call HMRC straight away to get it fixed and claim your money back.
And here are a few more to keep on your radar. With joint accounts, the interest is automatically split 50-50 for tax purposes, but if you actually own the money in different shares, you can use a thing called a Form 17 to tell HMRC to tax you based on your real ownership. Also, if you've got bonds overseas, don't forget that as a UK resident, that global interest is taxable right here. And this last one is a biggie. If you withdraw early and the bank charges you a penalty, you are still taxed on the gross interest amount before they took the penalty off. That's a really easy one to miss.
And hey, here's a quick pro tip for any of you out there who run your own limited company. If your company invests in a bond, that interest is company profit. That means it's subject to corporation tax, not your personal income tax. It is so important to keep your company and personal finances completely separate. If you mix them up, you can end up in a real mess and potentially pay tax twice on the same income.
So let's just boil everything we've talked about down to the absolute key takeaways. Number 1, tax is due when the interest is available to you. 2, use every last penny of your personal allowance and your personal savings allowance. 3, be smart and time your bond maturities to manage your tax bracket. 4, an ISA should always be your first thought for tax-free growth. And finally, number 5, always be on the lookout for those hidden traps like emergency tax.
Which really brings us to the final question you should be asking yourself. Now that you're armed with all this knowledge, take a good hard look at your own savings. Are they really working as tax efficiently as they could be? Or are you accidentally leaving a nice little tip for the tax man? Look, if there's any doubt in your mind, or if your own finances are a bit more complex, the smartest move you can make is to get some professional, personalized advice. The team at My Tax Accountant are ready to help you build a really optimal tax strategy. You can get in touch with them directly on WhatsApp or by phone at 07854 255 375, or you can drop them an email at info@mytaxaccountant.co.uk. Thanks so much for watching, and for more helpful guides just like this one, make sure you subscribe to the channel.